Okay. Hi, good morning, everyone, and welcome to the class. I think I haven't seen you for a bit. I know that you had a class in between. One of our colleagues took that class, but I haven't taken your class for nearly a month. So I'm glad to be back here. And as usual, please let me know if you are able to hear me and see me. Sometimes I just keep on talking and then I realize nobody has heard me. So just make sure that one of you just put in the chat box that everything is all right, that you're able to hear me and see me. Yep. So please do that. Great. Thank you very much, Robin. Now, we are somewhat midway in the course, and this is a good time for us to step back and say a few things about the course, get some feedback from you as well. Um, Let me begin with this. The mandate for today is that I talk to you a little bit about where we have come so far, and I will tell you about what I want to do in this session today. Today's session is important for me because this is a session where I want to take off a little bit from what we have been doing so far, and that will require your assistance. No pressure. No, we're not going to judge you or anything like that. But we are what we're trying to do here is see how you can harness the skills and the knowledge that you've been going through and see if we can make something of it today, right? So make you start thinking like people who have some idea of what how tax can be engaged with in other areas, commercial areas of our life, right? So that's the mandate for today. I'll come to that in a second. I'll make you do some stuff with me. But before that, I want to say, where are we now? Where are we today, right? We are roughly midway. We've already done more than half of what needs to be done for your course. What have you done so far? What have you achieved together? We have got a good conceptual understanding of the basics of income tax law. By basics, I mean the nature of income, the nature of capital, the scheduler system of taxation. How is income taxed differently under each of the schedules? We've gone through the schedules in, for example, income from salary, income from business, income from capital gains, and then I think last week you did income from other sources. Um, we have noticed that the Income Tax Act has a detailed structure that is global in some ways, in the sense that we are talking about income and we are talking about the Income Tax Act 1961 as a whole, but it's also in some ways local in structure. And by that, we mean that the calculation, the methodology of how to figure out if something is taxable and to the extent that it is taxable is all figured out under a particular schedule. Just give me 1 second, please. Sorry, just give me 1 second. Sorry for that. And I know that some people have joined a bit late. So can I just repeat what I was saying? Please indulge me for a second. I said that we are at a stage in our course where we are able to, we're managing to reflect on what's happened so far. And the Income Tax Act is in some peculiar fashion, both global and local in scale. It's global because the ideas of income and the ideas of capital are ideas that percolate through the act in various ways. We see those ideas in the schedule on professional and business income. We see similar ideas in the schedule and capital gains. There is a certain theme or a thematic unity to the Income Tax Act, and we can see that thematic unity in through from the definitions in Section 2 right through the five schedules that we deal with in the Income Tax Act. At the same time, the Income Tax Act is conceptualized in a very local fashion, in the sense that each of the schedules are paramount in trying to figure out how to tax uh, a particular item of income and to what extent. So, both in terms of substantively whether an item of income will fall under a particular schedule, and also how to calculate the income tax on that item are both decided pretty much at the scheduler level, thus making the scheduler, the local part of the Income Tax Act, a key player in income tax jurisprudence. Sometimes people tend to forget that, right? Some people sometimes think of Income Tax Act as this monolith, but it's actually not a monolith. It's got all these structural parts to it that have their own autonomous regime, so to speak. And we noticed some of that when we discussed the capital gains schedule just before I mean I left. That's the last time I discussed that with you, and we discussed some very interesting aspects of those of that schedule. So that's so far as the Income Tax Act's structure goes. Both structurally and conceptually, the Income Tax Act is interesting for us because it's got the scheduler system, and there's got all those issues within each of those scheduler systems. So, for example, when we discussed professional business income, we discussed the difference between capital revenue receipts and capital revenue expenditure. And then when we discuss the capital gains schedule, we discuss the idea of transfer and what that means, and how the very concept of transfer results in a certain trigger on capital gains, and we discuss some cases about that. So you might then wonder, what are we discussing today, right? And today is, and as I kind of signposted at the beginning of this lecture, today's talk is in some ways a takeoff on what we've done before. In the sense that I want to see how we can make use of the conceptual tools that we've had and we've discussed, and see how we can apply it now to some rudimentary ideas of tax planning. I say rudimentary because we're not discussing kind of complex tax structures, but we'll be discussing some foundational tax planning structures. And that brings me to today's topic, right? Which is corporate distributions, right? Or what we have termed as the problem of double taxation at the corporate level, right? And that is what I want to discuss with you today. Uh, when I do that, when I go over this domain with you, this subject area of today with you, you will then come face to face with two things. One, ingenuity in tax planning. How do taxpayers and their advisors, how do they imagine the tax system and see how they can make the best of it? But dovetailed with that idea of ingenuity is legislative or statutory complexity. And so you will have to get down now deep in the water with me, and try to look at all these legislative provisions, which we look at together, and see how we can use statutory language and how that statutory language engages with tax planning. That then will set the ground for our discussions later, subsequently in the course, on tax planning, tax avoidance. What does the law, how does the law deal with it, and those kind of things. Great. So we'll start off. Before we start off, any questions, comments, chats on the box? Today we have a number of participants, so it'll be great. The one thing that I want to tell you, this is something that I've been saying to you before. Just give me a second, please. Sorry, I've been saying this to you before, that even compared to this is the second iteration of this course. Even compared to the previous iteration, what we have noticed is a lot more class participation and class engagement, and we want to encourage that. The idea of class participation or class engagement is not for me to know how much you know. That's not important for me. It's What's important for me is to see if you're engaged. If I'm able to trigger some thoughts into you, that then you're able to bring forth to the table. So there's no judging. In fact, there's no impact at all on the substantive aspects of what you're going to say. What we are encouraging is for you because online teaching otherwise has this challenge that we're not seeing you face to face. We're not able to, you're all just black boxes on the screen. We're not able to engage with you in that kind of human to human way that we would like to in a classroom. The National Law School has played a great amount of emphasis on classroom teaching and the benefits of classroom teaching. And we want to bring that same idea, the same excitement of learning to online teaching as well. But we need your help for that, right? And so we know that you're all at various stages of your engagement with the law. Some of you are new to the law, some of you are not. Some of you are busy professionals, some of you are not. So I know that many of you are coming from different backgrounds. That's perfectly all right with us. But what we need from you is not contribution of knowledge. We don't expect that at this point of time. You're here to learn, but what we expect is engagement, right? And the more we engage, the better it is for you and for your peers, for the rest of your classmates as well. So that's what I wanted to say before I start, particularly in sessions like this, like today's sessions, where we are not only doing some some simple analysis of law and facts. We're trying to go to the next level and try to see how we can use whatever we have done so far and build on it. And we need a lot of engagement, just engagement, nothing else. And it'll be great for us to do that. Also, remember we are in an online session. We are here to not just learn but enjoy learning, right? The joy of learning, the idea that we discover things together. That kind of stuff is not. It's possible. It's more difficult to manage unless we have some engagement. So that's my spiel about engagement and about the fact that I would love to hear from you. But that, of course, we'll see as we go on. All right, now we are going to start on our topic, which is corporate distributions. I'm just going to start sharing my screen, and then I'm going to just set the ground for all of us to discuss. Right? Okay, just give me a second, please. All right. Perfect. And you will have to tell me on the chat box that you're able to see what's going on the screen. Yeah. So once I know that, then I'll be able to get back. So just confirm to me that you're able to see the screen. Just one of you, if you could just put in the chat box or tell me orally, whichever way you prefer, that'll be great. Yes, perfect. Thank you very much. So this is concept of double taxation at the corporate level. And why is this important? It's important, my friends, because now when you start, either when you in some ways come face to face with the application of tax law in a business context, in a commercial context, you will realize that basically tax law has everything to do with companies, right? It's the main players in the market, the people who are who are making a lot of money, who are investing in assets, who are trading. They're basically it's a world of companies, right? But when you say you're in a world of companies, when you say that you're in a setup in an ecosystem where companies are the main player, right? You come then face to face with a problem that has arisen because of the peculiarities of taxation and the peculiarities of corporate law, which is that corporate income is taxed at two stages. It is taxed when it is earned. So, company, Infosys, Wipro, they earn some money, they're developing software and selling it, or they're performing services which are software related. They're earning income. They are taxed when they're earning income. They're also taxed when that money that they've earned is given to their shareholders. We call it distribution, but you can call it by some other name. When it is given to the shareholders of Infosys or shareholders of um, of Wipro. So the first question I have for you, my friends, is why is it the case that there is this kind of taxation at two levels? Any idea? I mean, this you don't need tax law to tell me that. You can tell me otherwise. Why is it that when it comes to companies, and remember, companies are the main players in the market, why is it that when it comes to companies, you have taxation at a stage when they are earning income of various sorts, and taxation at the stage when they distribute their income? Why is it that? Why is the case? So, anyone, this is not a question to which you need not have studied a lot of tax law to answer this question. So, give me some speculative answers. Tell me what you think might be the reason for that. Yeah. Anyone, either in the chat box or you can tell me otherwise. If you want to speak up, that's fine too. But I'd love to hear from you. Yes, that is saying corporations are legal persons. Any person will be subject to tax. That's right. So corporations are legal persons, and they are therefore a different kind of tax unit. And because they're a different kind of tax unit, they are able to they're being taxed. Hindu is saying because shareholders in companies are separate entities, and that's right. And the law treats them as separate entities. Now, I don't know about you. When I was a law student and I read the Companies Act and I was taught the Companies Act for the first time, I was puzzled a little bit, I must say, because this is one of those conceptual points that doesn't come easily to people, right? Which is that the law has made up artificial entities. Right? So you have a trust, you have a partnership, you have companies. A company in particular is a very interesting artificial entity made up entirely because of law. It's a legal creature of law. And as a result of which, it has rights, responsibilities. It is the ability and duty to pay tax on its own, which means that it comes with itself some complexities of the sort I'm talking about, which is that it earns income, pays tax on it, and then its shareholders are considered distinct from it, and they then potentially have to pay tax on it when the income goes to them, right? When the money goes to them. Now the money has to go to them at some point of time because there's no point that of the money sitting in the company. The company may have rights, responsibilities, duties, but the company can't enjoy life, right? So in order to enjoy life, you need a human person, and that person needs money to enjoy life. So the problem we have is very simple. We have created an artificial entity, and now we have to live with the consequences of creating that artificial entity. And just as a matter of aside, there's a famous case. Remember, what I'm telling you right now wasn't all settled for some time, but then there's a famous English case called Solomon versus Solomon, which clearly established that companies have a separate and distinct legal personality. And after that, the jurisprudence has always assumed this. And once you assume this separate legal personality idea of, you then have to commit yourself to the consequences that follow, right? So that's where we are when it comes to when is corporate income taxed. It's taxed at two stages. It's taxed when it's earned, and it's taxed when it is distributed to the shareholders. And so that brings in its wake a lot of a lot of difficult issues, including the fact that although they're taxed, they may be taxed very differently. Just off the top of your head, if somebody can tell me when a company earns income, under what head will it be taxed usually? Yeah, this is a simple tax law 101 question I'm asking, which is when a company earns income, usually under what head is taxed? And Indu has said it's profit from business, which is correct. And when a company distributes income, say it declares a dividend, um, under what head will it be usually taxed? Under what head will the person who receives the dividend, usually under what head will that person be taxed? Yeah, receipt of dividend is usually income from other sources. That's correct. So already you see, as I was saying, the kind of the global and the local in the Income Tax Act. Yes, both are income and income for tax purposes, and they're taxable income. But already you see, even at this stage, that there may be a difference in the way they're taxed. One is business income, and the other is income from other sources, right? And that's Section 56 and the rest. Okay, so that's where we are. Now, when you have now, my friends, we have to all bite the bullet, right? Now we have to finally work with what we have. So we have a company that's you know earns some income. Fine, it pays income tax on it. Its income is taxed under the head profession, income from profession and business. Now, of course, the shareholders want that income. Is there any way that, and of course, we know dividends are going to be taxed under income from other sources. Is there any way that the company can extract money? Sorry, is there any way that the shareholder can extract money from the company without paying an additional tax on it, right? And in tax jargon, that's known as taking money out of corporate solution. Right? Can you take something out of corporate solution without paying taxes on it? Is it possible? Any way company can do it? Anybody has any thought on it, right? So okay, so Indu has said issuing additional shares, by which you meant that, but how will it issue additional shares in the without, whenever you issue additional shares, you'll have to pay a subscription money for it, right? The shareholder won't get shares unless you get subscription money for it, right? So how will you do that, right? Okay, somebody said bonus shares, but bonus shares will not result in the shareholder getting any benefit, any additional benefit, right? Because say that you own a share in the company and then you receive one more additional bonus share. Well, your share value of each of those shares will come down because you got now, instead of one share, you got two shares, but you haven't really benefited economically from that, right? So bonus shares may not be the answer. How else will you extract money? So this is the problem we have, right? How will you how will you take out money? We said dividends are going to be taxed. Well, then how do we take out money of the company without a problem, right? Without a tax issue, right? So, friends, this is why tax law is very interesting, because now you see a huge proportion of tax planning is actually about a huge proportion of tax planning, either in India or elsewhere, is actually about taking money out of the company and not paying tax on it. Yeah, because the company has already paid tax. So every shareholder thinks, why should there be another level of tax? And this is the issue of double taxation. And as I said, when you realize whether you're working in-house, you're advising companies, you're working in a law firm, this is the issue. The issue is, how do I take money out of the company and not pay tax on it? Right? And there are various complicated sections of the Income Tax Act that deal precisely with this issue. Right? Now, that, for example, has said that characterize the distribution as a return of capital possible. So you say that you invest 100 rupees in a company and you get some shares, and then the company returns that. Well, I would say the company earns 200 rupees, of which the company now wants to send you back 100 rupees. And the company says, well, if I send you back 100 rupees, it'll be dividends. So what I'll do is I'll say, I'm returning 100 rupees to you as return of capital. I will cancel some part of your your capital, right? You say you own 100 shares in the company. I'll say henceforth you will own 50 shares in the company, and I've returned 50 rupees back to you of that 200 rupees that I've earned. It's a return of capital. It's not. It's and therefore we come back to that unity of theme. It's a return of capital. It's a capital receipt. It's not a dividend, and then therefore there's no tax. And companies have actually done that, and so now the Income Tax Act has become very wary of those kind of tax avoidance transactions, and therefore they have the provisions that deal with it. And we'll come to those provisions in a second. Right. So I've asked you this question. Park that question in your mind right now. I've asked you the following question. You have money sitting in the company. You need to extract that money from that company without paying additional tax, right? And I said to you, a lot of tax planning in India and abroad actually is about this problem, right? And so this is a fairly important problem that we all need to think very, very carefully about. All right, how do we do that? There are various ways of taking money out of the company, and then the legislature has responded to all of those ways of taking money out of the company in one way or the other. We'll come to each one of those ways in a second, but before we do that, if I just tell you what it is, then it's going to get really boring really fast. So I'm not going to do that. What I'll do is I'll give you a problem. I don't Google it, don't research on it. Just spend some time thinking about that problem. This problem is on your screen. It says that there's some company and something is going on in that company, and what will be the tax result if something happens. What I want you to do is I just want you to just don't Google anything. Just see based on what you know so far, right? How will you go about answering this question? I'm going to give you. Let's see where we are. Yeah, I'll give you I'll come back at 9:35. I think that should be okay. I'll come back at 9:35 and see what you have said. Please remember the question I've asked. Don't Google it. I just want your kind of unvarnished thoughts on it, right? What do you think? If what you know so far, what do you think would be the tax consequences here? 9:35. I'll come back and I'll see what you Okay, all right, I'm back. So let's see what people have done so far. Um, let me first read out the problem for you. It says A is a 50% shareholder in company ABC. Okay, so there are other shareholders. A has a cost basis in his shares of rupees 10,000. And when we say somebody has a cost basis in his shares of 10,000, what we mean is that that person has bought those shares or subscribed to those shares for rupees 10,000. So that's what it cost that person. And ABC has accumulated dividends of rupees 100,000. Um, Actually, I should have said, sorry, if you all could just make a note of it. I should have mentioned there. A has accumulated profits of rupees 100,000. That's the technical word, not accumulated dividends, accumulated profits. And As you see, accumulated profits is a word used in various parts of the Income Tax Act, and it's a term of art. It's a term that is mentioned in accounting terminology. It's a term from accounting terminology, and what it means that a company is sitting on a certain pot of money, and that pot of money can have various components. It could have taken that money from its shareholders, so that will be capital. It could have taken its money from lending institutions like banks, and that would be loans. And so, therefore, it has creditors, it's a debtor to a bank. And then it has money that it has earned because it has traded or manufactured things and sold it and therefore made a profit. And so accounting principles divide the financial resources of a company in that way. The company has financial resources. We can take it as cash because of capital subscriptions, because of debt, and because of profits. Right, and it's the profits that we are concerned with here, right? Because those profits are that have been earned by the company and have been taxed at the company level. Now, what happens to those profits when they go from the company to their shareholders? And it's that profit amount that the income tax law is particularly worried about, because they don't want those profits to go to the shareholders without it being taxed. So ABC has accumulated profits of rupees 100,000, and then the facts say ABC is liquidated and A receives rupees 50,000 in the liquidation. What are the tax consequences for A under the ITA, and what would be the result if ABC had accumulated dividends? And again, you should say accumulated profits of rupees 20,000, and A received 40,000 in the liquidation, right? And so this is I'm giving you one way of one problem in double taxation, and then we'll discuss the other problems in double taxation as we go through, right? So now let me see before I tell you what I think about this problem, let's see what you have thought about this problem, right? And let's see. So we have Rohill. Let's talk with case one for the time being, and then we'll see about case two. Case one is um, income from other sources, rupees 50,000, less loss on non-receipt of shares amount, loss offset under LTCG, which is a 10,000. Um, okay, so I don't know. Very interesting response here from Rohil. Um, he's netting off capital losses against income, which is usually not allowed, and we'll come to that when we discuss cases. And then you have Dutt, who's saying the first 40,000 is a dividend, and the remaining 10,000 is a return of capital, which actually comes closer to the truth. Um, and Case two, 10,000 is a dividend, and 10,000 is a return of capital. 20,000 is a capital gain. Again, comes closer to what I'm trying to say here. All right, friends, let's see. Let's see, right? So we have a is a 50% shareholder in company ABC. A has bought or subscribed to the shares, and therefore it cost him 10,000. Now ABC has accumulated profits to distribute of rupees 100,000, and ABC is liquidated, and A receives 50,000 liquidation. Now let's, before we even go to liquidation here, right? Let's take a simpler situation. Ignore the words A is liquidated, and we just say A receives 50,000 from ABC. What would happen tax wise? Forget about liquidation for the time being. What would happen if A receives 50,000 from ABC? Let's start asking that question first. Yeah. So what would happen? Let's see. Any anybody wants to take a call on that? Just simple question. A receives 50,000, right? And then Indu is saying that's dividend income which needs to be taxed. That's correct, Indu. But how do we tax dividend income is the next question. And I suppose dividend is taxed um, in because it's income, so it's under Section 56, and it is taxed. In fact, if you go to section, all of you have to have your legislation with you, right? Because it's going to be slightly tough going now, because I'm going to ask you all to look at the legislation. Remember, no NLS course can be done. Maybe other institutions are doing it differently, but at NLS, it's really important. It doesn't matter what your legal background is, but you have to have some sense of the statute, right? And so you will have to look at some language in the statute, and then we'll see what happens. Okay, so I'm now asking a very simple question, guys. Rohil has also answered about capital and dividends. I'm only asking a very simple question. Forget about liquidation. What happens if there's just a simple dividend distributed, and Indu is right, it's dividend income, but how do we get to that conclusion? Because whatever conclusion we get to has to have a statutory backing. And so then you see, you go to 2 clause 22, section 2 clause 22 of the Income Tax Act. Clause A. Remember, again, one more thing, and I've been repeating this. We are all members of the transition generation. We are going from Income Tax Act 1961 to Income Tax Act 2025, but you don't have to worry about it. It's only the next set of people who take this course will worry about it. You will be only governed and tested on the Income Tax Act 1961. And substantively, there aren't that many changes in any case. So this course will discuss principles and concepts, and that will remain pretty much the same, whether you go to 61 or 2025. But because you people are still in this financial year, which is still governed by the 1961 Act, you will only be tested on that. So let's go to 2 clause 22. 2 clause 22 defines dividend, right? Dividend includes, it's an inclusive definition. And then the fact that I had just now discussed will come under that, which is, I'm just talking about a simple definition, which is what happens when 50,000 is distributed? And the answer would be in clause A, any distribution by a company of accumulated profits, and we discussed this idea of accumulated profits just now. Any distribution by a company of accumulated profits, whether capitalized or not, don't worry about it now. That's an accounting concept we don't have to worry about at the time being. If such distribution entails a release by the company to its shareholders of all or any part of the assets of the company, here there is a release by the company to his shareholders of cash, and that cash is an asset of the company, and therefore this clause will come under dividends. And then you will notice that Section 56, which is income from other sources, would be the kind of section that would cover some income of this sort. It says Section 56 says income of every kind which is not to be excluded from the total income under this act. I'm now reading Section 56. Income of every kind which is not to be excluded from the total income under this act shall be chargeable to income tax under the head income from other sources if it is not chargeable to income tax under any of the heads specified in Section 14, items A to E. And in particular, and without prejudice to the generality of the provisions of subsection 1, the following incomes shall be chargeable to income tax under the head income from other sources, namely, and then the first one, clause I, is dividends, and then it goes on to discuss other things. So, dividends, therefore, are taxable under the Act. Um, Here we come to something really interesting, which is that this kind of process, we understand income is being taxed just because it's going out, and so the person might very well say that, well, why do we do that? Why don't I just liquidate the company, especially if the company is a very small company, and I have made a lot of money. I've got a company that has a huge amount of profit sitting in it, and I say, well, too bad. If I if I take out money, it will be considered as dividend, and so that will not serve my purpose. So what I'll do is I will liquidate the company, right? I'll liquidate the company, and whatever money comes out will be tax free. My friends, if I liquidate the company and whatever money comes out is tax free, why, under what principle of tax law would it be tax free? Anyone? Because why is it that I'm trying to liquidate the company instead of declaring dividends? And why is it that any money that comes out then is tax free? Under what principle of tax law? What logic will it be tax free? Right? So remember, here I'm trying to do some tax planning, right? I'm trying to say, okay, forget about dividends. It's a small company. I don't need it any longer. I can always start a new company doing the same business. What I'm going to do is I'm going to liquidate this company. Let's say I'm 50% shareholder. Let's say I'm 80% shareholder. I'm able to control the company. I can figure out how to control the company, and I can liquidate it. Yeah, bankruptcy. But my question, Rohil, is not that. My question is, I agree that I can declare bankruptcy, and the company can be liquidated. My question was, when the company is liquidated and it sends money back to its shareholders, why is it that the shareholder can claim? Under what principle of tax law can the shareholder claim it's tax free? Why is that not subject to income tax? That's the question I was asking. That's the question I'm asking.
So it can come under loss of a potential source of income.
Okay, and therefore, just follow through that logic. It
So
comes under, yeah.
because it's a loss, um, it doesn't come under income per se. It comes under loss of a long-term, like an asset.
That's because your share has gone out of existence. Is that what you're trying to say?
Yes, sir.
And that share was a source of profit, and that share is gone, and therefore, just complete the logic. Tell me, and therefore,
And therefore, since it is a loss, you can't really be charged on it.
no. But again, why not? Just follow through with the logic. You're doing well. Just tell me why. Okay, so you have an asset, you lose that asset, and you get some money in return for it.
Mhm.
Why are you not being taxed on it?
So it's a compensation.
But okay, let's say it's compensation for loss of asset. Why are you not being taxed on it? Others can chat and put it in the chat box while we're talking. Yeah. I'm just you're looking for some magic words from you.
Mm.
Okay, it's a capital receipt, is what you're trying to say, I think, right? It's not an
Yeah.
income receipt
Yes,
at
sir.
all. It's a capital. So
Yes.
remember the magic in tax law is this: you can economically be better off and yet not be taxed on something, right? And the only way that's possible is if what you receive is a capital receipt and not an income receipt, right? Because clearly you're economically better off, right? Because you put whatever you put 50,000 in that company and you're receiving more than that, right? So clearly you're economically you're better off, but you're not in terms of tax. Doesn't matter because you're receiving a capital receipt. That is the argument that many shareholders used to use, which is that if we are in bankruptcy, if we are a company that's being liquidated, whatever comes out of the company is just return of capital to the shareholder. Shareholder puts some money into the company and the company gives back some money back to the shareholder. That is a capital receipt, can't be taxed, right? And therefore, what they were doing is they were converting what normally ought to have been taxed because of dividend into a non-taxable event, right? And that is what uh, the legislature was not very happy with. So I'm going to ask you to go back to section 2, clause 22, and I'm going to ask you if you see section 2, clause 22 has an expanded definition of dividends. It has section 2, clause 22, A, B, C, D, and E, and F, right? There are five clauses under which the idea of dividends has been expanded. And the clause that we are particularly interested in here, and we're going to go through all the clauses, but the clauses we are particularly interested in here is clause C, which is any distribution made to the shareholders of a company on its liquidation to the extent to which the distribution is attributable to the accumulated profits of the company immediately before its liquidation. Don't worry about whether capitalized or not, right? And so in our facts, A 50% shareholder in company ABC. A has a cost basis in its shares of rupees 10,000. ABC has accumulated profits of rupees 100,000. ABC is liquidated and A receives 50,000 in the liquidation. And this 50,000, because there are already accumulated profits of 100,000 under section 2 clause 22 clause C, this receipt of 50,000 will now be statutorily deemed to be a dividend. And because it's statutorily deemed to be a dividend, you are going to end up paying tax on it to the extent that you have your that you have accumulated profits. So so what happens to this 50,000? All of the 50,000 is going to be considered as dividends, right? Because what's basically happening here is that you are trying to extract money out of the company and avoid dividend status by liquidating the company. Right. So this is a complexity that has been developed in response to tax avoidance efforts by taxpayers. Um, Now, suppose we did not have this this kind of provision, then you will have to go to section 46. I request all of you now to go to section 46 with me because some of you had questions about the 10,000 and capital gains. If you go to section 46 of the Act, you will notice that section 46, which is in the capital gains schedule, says, notwithstanding anything contained in section 45, where the assets of a company are distributed to its shareholders on this liquidation, such distribution shall not be regarded as a transfer by the company for the purpose of section 45. So the company is not going to be taxed. That's what section 46 clause 1 says. That's from the company's point of view. But in this problem we're discussing, we're talking about the shareholder. Shareholder level issue is discussed in section 46 clause 2. Where a shareholder on the liquidation of a company receives any money or other assets from the company, he shall be chargeable to income tax under the head capital gains in respect of the money so received or the market value of the other assets on the date of distribution, as reduced by the amount assessed as dividends within the meaning of subsection C of clause 22 of section 2, and the sum so arrived at shall be deemed to be the full value of the consideration for purposes of section 48. In this case, of course, what has happened is that the shareholder on the liquidation of a company has received some money, but that money is uh, uh, if it's reduced by the amount assessed as dividend. So he's received 50,000 as the money, he shall be chargeable to income tax under the head capital gains in respect of the money he's received. He has received 50,000, but it's reduced by the amount assessed as dividend. The amount assessed as dividend is 50,000, and therefore the sum arrived at would be zero for purposes of consideration in section 48, and therefore he will not have any capital gains recognized. The reason why he will not have any capital gains recognized is because the section 2 clause 22 clause C has now fully recognized whatever he has received as dividend for income tax purposes. Therefore, there will not be any capital gains. He will not be taxed. There won't be any capital gains issue here. There won't be any capital gains, but the capital gains will be zero by virtue of section 46 clause 2. But he will have 50,000 rupees as dividends for purposes of section 56. So he will pay at a slab rate, as somebody put it, rupees 50,000 on rupees 50,000. Any questions or comments so far on how this is done? You see, friends, I have to say one more thing to you, because some of you may find this a bit confusing. So let me step back and say a few more things to you. When, in order to escape income tax on dividends, let's say that the company had just given dividends to the shareholder. Let's say A had received dividends of 50,000 from the company. Things would have been very easy. You would have gone to section 56, you would have read section 2 clause 22A, and you would have said a tax on dividends. Things get complicated when, instead of doing that, A has tried to do some tax planning and has decided that the company will be liquidated. A is a 50% shareholder, so he has control over the company. You can even say, if you want to be even more sure, you can say 60% shareholder, so he has majority control. And so he's able to trigger bankruptcy if he wanted to. And um, he gets some money. Now, when he receives that money, that sum of money, the issue with the sum of money is that that sum of money looks like a return of capital, and it also looks like A is trying to do something to escape tax. So both the capital gains aspects of that liquidation transaction, as well as the dividend aspect of that transaction, has to be addressed by the income tax authorities. They've done it by putting a rule in section 2 clause 22, saying that a certain amount of that money up to the accumulated dividends will be taxed as up to the accumulated profits will be taxed as dividends. And then they have said, for capital gains purposes, to the extent that it's taxed as dividends, you will not have any capital gains on that amount. And that's what you see reflected in the interplay between 2 clause 22 clause C and section 46. So after the dust settles, what has really happened is the legislature has said, whether you would have taken out 50,000 of the company by dividends or by liquidation here, the ultimate result is the same, which is that 50,000 will be considered as deemed dividend, as a dividend, and therefore income from other sources in your hands, right? So that's where we are. Interesting. I personally think it's a very interesting way in which the legislature comes in and changes the character and receipt of a character of the receipt of money in your hands, and then tells you this is what the tax consequences are going to be. Right? This is, I think, a great example of that. We'll take a 10-minute break now. We are at 10 o'clock. And when we come back, we'll discuss the second part of the question that we have been talking about and some other ways of extracting money out of the company, and seeing if we can or we cannot pay tax on it. Yes, we'll be come back in 10 minutes. Okay, hi, I'm back. So we were talking about the second part of the question, which is what are the tax consequences for A under the ITA if ABC had accumulated dividends of rupees 20,000 and A received 40,000 in the liquidation. Now, this is an interesting problem because this means that A would have received 40,000 in the liquidation, of which 10,000 rupees, 10,000 would be the accumulated, would relate to the accumulated dividends because A is a 50% shareholder. So A has, therefore, 10,000 would be considered as dividends under 2 clause 22 clause C. Then Section 46 kicks in, and Section 46 is the mechanism of Section 46 is that Section 46 says whatever you receive in the liquidation, you must subtract from it whatever has been considered as dividends. So you got 40,000 in the liquidation. You subtract from that 10,000, which is considered as dividends, and therefore you're left with 30,000. So that 30,000 is considered as consideration for purposes of Section 448, and therefore, then you calculate capital gains. The capital gains would, in this case, will be 30,000 minus 10,000 because his cost in the of the shares is 10,000, and therefore the capital gain is 20%, and that capital gain will be taxed at a certain rate, 12.5%, and if it is a long-term capital gain, otherwise slab rates if it's short-term capital gain, and those consequences will follow. So you notice here that in your second part of the question, you have a certain very interesting and I think complex but potentially fascinating area of tax law. You have a certain amount of money being received by the shareholder. That money, that character of that money it's been characterized differently. Sorry, just give me 1 second. Just give me a second, please. You're receiving a certain amount of money from the company. That money is being divided by virtue of the application of Section 2, Clause 22, Clause C, and Section 46, Clause 2. That money, in this case 40,000, is being divided into two parts. 10,000 of which is considered as income from other sources, dividend income from other sources, and 30,000 of which is considered as consideration for capital gains purposes. Because it's consideration for capital gains purposes, you are allowed under the capital gains schedule to net your cost from it, and therefore there is a capital gains of 30,000 on which you're going to be taxed, you're going to be assigned capital gains for that amount, right? Sorry, there's going to be a capital gains of 20,000 on which, because it's 30 minus 10, on which you're going to be assigned capital gains. So you notice here the way, because of the fact that a liquidation event has happened and some amount of money has been received, and a certain part of that money has been deemed to be dividends and income and not capital receipt, you notice that legislatively, we have now the operation of two schedules on the same amount of money, dividing the money into two parts, right? Um, Complex, but also, I think, fascinating. Before I go on to the next stage, any questions or comments or doubts, or if you didn't understand what I was saying, anything that you think? And let me just look at the comments to see if people are on the same page. Yeah, so case one, Rohil, I'm just going through each of the comments and then I'll give you because it's important that we discuss it in a peer group. Rohil, as I mentioned, case one would be just 50,000, because whatever he has received is basically going to be dividends as a deemed dividend, and there's no offset here at all. And whereas case two, you're right, it's 10,000, and then there will be a long a capital gain long-term capital gain. If he had held it for more than 2 years, it'll be 20,000, as you have rightly put it. Um, that is said the same thing, that you're absolutely right. Um, and um, and you notice that um, that is indeed the case, except that in case one, you're wrong. Case one, statutorily, what happened is that the entire amount of money is being considered as dividends and zero capital gains. But in case two, that's right. 10,000 will be a dividend, and then 20,000 will be capital gain. Intulika said it's dividend income which needs to be taxed. That's right. And Rohil has actually corrected himself and said it is 50,000. Great. So that's been a great contribution from all three of you. And I think you, at least we've got some taste of the complexity of tax planning and therefore the complexity of legislation in response to this kind of tax planning. We think we got a good sense of that. Now, that's not the only way, though, to, if you notice, to take out, extract money. And so, what I'll do now is for the next several minutes, I'm going to go through various other ways of extracting money and the tax consequences that follow. At any point of time, if you have any questions or any doubts or any comments, please let me know immediately. The topic's a bit complex, but what I find, whenever I've done this for years. Whenever I either teach it or I study it further, you notice how uh, it's technical, but it's also imaginatively fascinating for us to read, how both in terms of how the taxpayers have looked at how to extract money and how the legislature has tried to address that. Right. So here's the. I've given you one example. You can say dividends extraction. Um, you have this issue. If you extract by way of dividends is just income tax, then taxpayers come in and say, hold on, we have various other ways of doing it, and the legislature has tried to address all those other ways of doing it in a piecemeal fashion, resulting in the complexity that we are talking about, including the scheduler complexity. That there's a scheduler part of it, there's a capital gains part of it, and there's a dividends part of it here, in this problem. Now let's go through, liquidation is just one example, right? And Rohil, and I think Dutt has given another example: return of income, return of capital. Let's go through all the various scenarios in which money is going to be extracted from the company. It comes out of corporate solutions, so to speak, and how we deal with those issues, one by one, right? So distribution of corporate income, you have first the easiest way is on your top left hand corner, distribution of dividend, and there's tax on it. Now, there was a tax under the old regime and the tax under the new regime. Under the old regime, and I'm going to refer you to section 115O. Under the old regime, and I'm going to read section 115O. And when I say old regime, I mean that regime is no longer in place after um, 2020. And so we have a new regime. Under the old regime, it said tax. I'm going to read out the first part of the section: tax on distributed profits of domestic companies. This is, of course, applicable to domestic companies. 115O, notwithstanding anything contained in any other provision of this Act and subject to the provisions of this section, in addition to the income tax chargeable in respect, sorry, just give me a second. Okay. In addition to the income tax chargeable in respect of the total income of domestic company for any assessment year, any amount declared, distributed, or paid by such company by way of dividends, whether interim or otherwise, on or after the first day of April 2003, but on or before the 31st day of March 2020, whether out of current or accumulated profits, shall be charged to additional income tax, here referred to as a tax on dividend distributed profits, at the rate of 15%. Um, my friends, can any of you tell me this 115 clause O? If you just read it, and just if you can read it for a second here, how is it any different from a shareholder receiving dividends and being taxed on it. What is section? What is the difference between section 115O and a shareholder getting taxed on dividends? What is different about 115O? Anyone? Think about it. Just read the that paragraph carefully for me and then tell me. Anyone? I'll give you 2 minutes. So I'm going to give you two differences. The first important difference in section 115O is that the tax is on not on the shareholder, but it is on the company. Indu is absolutely correct. The tax responsibility is on the company, and she's also right in saying tax deduction responsibility in the sense that when the company is paying out the money to the shareholder, the company has to deduct the tax on it and send it to the government. And so this is a tax on the company, not on the shareholder, even though the distribution is going to the shareholder. The second difference is that it's a flat rate. It's 15%, right? It doesn't depend on the slab that the shareholder is in, right? So it's a flat rate. So these are the two important differences. Indo, thank you very much. That's a good intervention. And that regime is no longer there. The regime now is that the shareholder is taxed directly after 2020. I've also mentioned here Section 115 BBDA, which is part of the old regime. And in that, in addition to for the company paying 15% tax, if the shareholder received more than 10 lakhs in a year, he was being taxed as well. And that I'm not going to go through it in any detail, but that's 115 BBDA, which did that. Now, if you see BBDA says that notwithstanding anything contained in the act, where the total income includes income in aggregate of exceeding 10 lakhs by way of dividends, then the the person receiving that dividend would pay 10% on it, right? And that was an additional tax on the shareholder at the shareholder level. Now, today we have the new regime is simpler. The shareholder just pays tax on the dividends at whatever slab rate level that he finds himself in. Right. Now, why am I making you read these sections? I'm making you read these sections for you to understand and get used to and be familiar and be comfortable with statutory language. Right. So, one more thing about Section 115O, for example, is it says notwithstanding anything contained, it starts, Section 115O starts by saying, notwithstanding anything contained in any other provision of this Act and subject to the provision of section. So basically, it's a non obstante clause, as we say, this notwithstanding anything contained in any other provision of this Act. And basically, what Section 115 does is just creates out of thin air, so to speak, a tax liability. Never mind scheduler system, this, that. We don't even have to worry about which schedule we're going to fix this dividend distribution tax in, this 15% tax, because Section 15 says, notwithstanding anything in any other part of the Act, this is the tax that will be paid, which is 15% on any dividend that comes out, and that's that, right? So that is the way in which the kind of vanilla variety distribution of dividend was being taxed earlier, and now it's a much simpler regime. Then I have talked about buyback of shares on the left side. But before I go to buyback of shares, just look quickly at the distribution because of liquidation, and there we have already talked about the interaction between Section 2, Clause 22, Clause C, and Section 46. Um, and then if you look to the right side, I've said issuance of bonus shares, particularly bonus shares to preference shareholders, not equity shareholders, would be considered, will add some economic benefit to the preference shareholders, and therefore would be considered um, as uh, as dividend. Um, let me do this systematically with you. Go back to the top left hand corner. Top left hand corner says distribution of dividends um, will be considered as a dividend. Why is that? That's under Section 2, Clause 22, Clause A, which we have already done it. And then I've told you the old sections that dealt with distribution of dividend. If you go down in the sheet to the liquidation issue, which is in the kind of center bottom half of the screen. Distribution because liquidation, Section 2, Clause 22, Clause C, read with Section 46 applies to it. Then, if you go to the top of the sheet, and if you look at issuance of bonus shares to preference shareholders, we know that issuance of bonus shares to equity shareholders don't make a difference to their economically, so it's not considered as dividends. But issuance of bonus shares to preference shareholders, because preference shareholders are shareholders who have a fixed rate of income of dividends on their shares. But then if they get equity shares uh, as bonus, then it does make a difference to them. Actually, they get any shares, even if they get preference shares, it makes a difference to them. So issuance of bonus shares to preference shareholders would be considered as dividend, and the statutory justification for that is in Section 2, Clause 22, which, as you know, defines dividends, and it says here, Section 2, Clause 22. Um, let's see. Yes, 22, Clause B says that any distribution, I'm now reading Section 2, Clause 22, Clause B, any distribution to its shareholders by a company of debentures, debenture stock, or deposit certificates in any form, whether with or without interest, it's debentures, and of course debentures will be taxed because they're like money's worth, and debentures can be to any shareholder, preference or equity. And then if you look at the second part of clause B, and any distribution to its preference shareholders are shareholders who are entitled to a fixed rate of dividend. So any distribution to its preference shareholders of shares by way of bonus, could be any shares, preference or equity, of shares by way of bonus, to the extent to which the company possesses accumulated profits, would be considered as dividends. If you're a preference shareholder and you get another set of preference shares as bonus, that means now you're going to get much more dividends than before, and that would be considered as dividend distribution. And then if you go down the sheet, reduction of capital, that's the example, I think. And now that's also considered as a deemed dividend. So that's in section 2, clause 22, clause D. It says any distribution to its shareholders by a company on the reduction of its capital. Otherwise, people were saying, look, all I've done is reduce my capital. In return, I've received a capital receipt. And it's not taxable because it's a return of money because of a reduction of capital. As Romil was putting it, it's loss of an asset, etc. Now those arguments are gone. Legislatively, it's been deemed that any distribution to its shareholder by a company on the reduction of its capital to the extent to which the company possesses accumulated profits will, to the extent of that, will be considered as dividends. Now that leaves two more strategies or three more strategies, which are buyback of shares or loan advances to shareholders or gifts. Gifts is easy. Section 56, Clause 2, Clause X. Say the company has a lot of money and then it starts gifting cash to its shareholders. That will be caught under Section 56, Clause 2, Clause 10, Clause X, as it's called, as a gift, and therefore taxable to the shareholder. Again, so you can't extract money from the company by way of gifts either. That leaves us with two more ways of getting money out of the company and trying not to pay tax, both of which have been addressed. One is loans to shareholders, which we'll come to in a second. But before that, buyback of shares, right? So the company says, fine, the shareholder says, fine, I'm not trying to get dividends from the company. I'm again trying to get a capital receipt, which is basically I'm asking the company to buy back my shares. So this is not a distribution of dividend. This is just a buyback of shares. And for buyback of shares, again, we had a fairly complicated old regime, and the new regime is not as complicated as that, and we'll go through that. I'll request my friends to go to section 115 QA, right? So 115 QA and 115 QA says very clearly that a buyback of share would be caught. It says, I'm just going to read out the first paragraph of 115 QA. This is the old regime, by the way. Notwithstanding anything contained in any other provisions of this Act, in addition to the income tax chargeable in respect of the total income of a domestic company for any assessment year, any amount of distributed income by the company on buyback of shares from a shareholder shall be taxed, shall be charged to tax, and such company shall be liable to pay additional income tax at the rate of 20%. So remember, there were all kinds of different rates for in the old regime for dividends. Under 115O, it used to be 15%. Here in the old regime for buyback of shares, it's 20%. Yeah. And then, of course, when you have a buyback of shares, um, you know, you you have a problem because you're trying to skirt the dividend distribution requirement, and therefore you the income tax authorities are saying you have to pay a flat 20% rate. And then under 10 clause 34A, under 10 clause 34A, this at the shareholder level was being exempted. Okay? So under 10 clause 34A, it said that any income, section 10 clause 34A, any income arising to a company being a shareholder on account of buyback of shares by the company as referred to in section 115 QA is now one of those incomes that has been exempted under the old regime. Therefore, under the old regime, when the money was going out to the shareholder, buyback of shares, the shareholder was not being taxed. It was a company that was being taxed under 115 QA at the rate of 20%. Similarly, under section 10 clause 34, which is the section before 10 clause 34A, income when dividends were going out, the company was being taxed under section 115O, but at the shareholder level, when the shareholder received the dividends, that income was exempt. Any income by way of dividends referred to in section 115O was exempt. Remember, section 10 lists out all the items of income that are exempt from income tax, right? And so what the old distribution of dividend tax and the old regime on buyback was doing was to tax the company at the level of the company itself and exempt the shareholder from tax when the shareholder received the tax. Under the new regime, you have section 2, clause 22F. I want all of you to go to that. The new regime related to buyback of shares, section 2, clause 24F. And that clause says that um, any payment by a company on the purchase of its own shares from a shareholder in accordance with the provision of Section 68 will include, will now be considered as dividend. So now you have a similar situation that you have money on a buyback of shares, you have money going out to the shareholder, and that money is now being considered legislatively or statutorily as income, dividend income for dividend purposes. But then you have Section 46A, which, because there's also a capital gains issue here, as you know, and much like in the case of liquidation. And in Section 46A, not 46 clause A, Section 46 capital A, Section 46 capital A says, and I won't read it out, that where the, and I'm going to go to the proviso, where the shareholder receives any consideration of the nature referred to in subsection clause F of clause 22 of section 2 from any company in respect of any buyback of shares that takes place on or after the 1st of October 2024, then for the purposes of this section, the value of consideration received by the shareholder shall be deemed to be nil. Okay. Um, and um, let's read the first part of section 46. Where a shareholder or a holder of other specified securities receives any consideration from a company for purchase of its own shares, then subject to the provision of section 48, the difference between the cost of acquisition and the value of consideration received by the shareholder shall be deemed to be the capital gains arising to such shareholder, and as the case may be, provided that where the shareholder receives any consideration of the nature referred to in subsection subclause F of clause 22 of section 2 from any company, then the value of consideration received by the shareholder shall be deemed to be nil. Now, I have a small question for you people, and you will have to address it. I'll give you exactly, I know it's a bit complicated, but I'll give you exactly 5 minutes to answer this question. Go back to the previous slide where I've said that um, A is a 50% shareholder of company, A is a cost basis in his shares of 10,000. ABC is liquidated and A receives 50,000 liquidation. Let us say in this first question, not the second question, first question. Let us say that I say that ABC is not liquidated. I'll say that A receives 50,000. A receives 50,000 in return for a buyback of all his shares. All right, I'm repeating my question. I'll say A receives 50,000 in return for the buyback of all his shares. Okay. What do you think are the tax consequences to A under the current regime? What do you believe are the tax consequences to A under the current regime? I'm going to give you 5 minutes to think about it. All right, I'm back. Now, the question I asked was in the previous case, if the ABC had not been liquidated, but ABC just bought back the A's shares and paid him 50,000, what would be the consequence? And we'll under the new regime. And under the new regime, you notice that Section 2, Clause 22, Clause F says that the entire amount received by A would be considered as dividend. And then under Section 46A, it says that where the shareholder has received, well, let's start with this. Section 4, now, the problem here is this. Section 46, why are we talking about Section 46A? Because the same amount that is received is potentially subject to both the capital gains schedule as well as the income from other sources schedule. We know that income from, and what the legislature is trying to do is trying to make sure that they capture a certain amount as income but also give some relief to the taxpayer. So what the legislature has done here is it has said that if you have a buyback of shares scenario, then whatever you receive as a result of the buyback is going to be the entire amount, 100% of the amount that you receive as a result of the buyback would be considered as dividend and therefore income from other sources. But remember that you had spent 10,000 and you had either bought the shares or you had subscribed to the shares. And so the legislature gives you some relief about that. So what it says is that for capital gains under Section 46A, the general rule is when there's a buyback, the shareholder is subject to capital gains tax, which is the difference between consideration and cost. And then the proviso to Section 46 says if the buyback is hit by Section 2, Clause 22, Clause F, then it is deemed that the consideration received is zero, nil, and therefore you have a minus 10,000 loss, capital loss sitting there. And you can use that minus 10,000 capital loss for against to net income from if you have capital gains somewhere else, you can reduce that capital gains. So it has a tax benefit because that capital loss can be netted to reduce other income, typically capital gains from selling other assets that you might have. So there's a benefit. And in fact, I think you have a similar benefit in Section 46, where Clause 2 says that the value of by virtue of Clause 2, if the dividend on liquidation is recognized as dividend income, if the income from if the distribution in liquidation is recognized as dividend income, then your consideration is reduced to that extent, and you may get into the same capital loss situation there as well. So that is what I wanted to tell you. That's kind of interplay uh, between capital gains provisions and the income provisions. Um, Before I go ahead, any questions, comments, doubts? You want me to explain something? Anything that you people are doubtful about? Please let me know. Um, I wanted to summarize what I've said so far by saying that when you have a situation in which the taxpayer is indulging in tax planning and either creating a liquidation situation or a buyback situation, you have a problem. You have a problem because the amount can, although by default it should be under the capital gains regime, has now come under the income tax, under the income from other sources regime, and therefore the tax act gives you a little bit of relief for the amount you've spent on either buying or subscribing to that capital shares in the way that we have just pointed out, right? And um, and so that's what I wanted to show you. Um, Now, um, we have one more. We have about 10 minutes left, and so we have one more issue to do, which is the issue of loans. we have said, so where have we come so far? We have talked about uh, plain vanilla distribution of dividends. We have talked about buyback of shares. We have talked about distribution because of liquidation. We have talked about issuance of bonus shares. We have talked about reduction of capital, what and gifts. But what we haven't talked about, another way of extracting money from shareholders is loan advances to shareholders, right? And that is covered under Section 2, Clause 22, Clause E. And so and what we've said is what problems would arise if the company provides loans to its shareholders. Let me read out Section 2, Clause 22, Clause E. Section 2, Clause 20, Clause E says dividends includes any payment by a company not being a company in which the public are substantially interested of any sum by way of advance or loan to a shareholder, being a person who is the beneficial owner of shares, not being shares entitled to a fixed rate of dividend, that's preference shares, holding not less than 10% of the voting power, or to any concern in which such shareholder is a member or a partner and in which he has a substantial interest, or any payment by any such company on behalf of or for the individual benefit of any such shareholder to the extent to which the company in either case possesses accumulated profits. Complicated section. The way we understand this is by trying to read through this by looking at it through a problem. So I'm going to give you a problem and I'm going to ask you to look at the problem. I'm going to give you probably 5 minutes. Look at the problem and see if clause E will apply to this, apply to the question I've asked. And I don't know whether we'll be able to do the entire discussion in this session. We may have to do a little bit of discussion outside in the next session as well. But first, I wanted to give me a preliminary remarks on just look at this scenario I have given you and try to answer that question by applying 2 clause 22 clause E. I'll just give you 5 minutes to get you a sense of a taste of what it is, and then I'm going to come and ask you. I'll at least set up the issue for you, right, when I come back. Yeah, I'm back. I gave you this example to ask you whether there will be a loan situation. Um, what I want you to take a look at is who's receiving the loan. We said company two gives a loan to company one. Has company one, right? Not the shareholders of company one. Has company one received dividends under the ITA? So this is what I want to for you to focus on. Whether company one has received dividends ITA, whether section 2 clause 22 clause E is capacious enough to cover this kind of situation where a company one has received dividends from ITA and whether that and therefore will be impacted by section 2 clause 22 clause E. I noticed that we're running out of time, so we may not be able to address this in this session, but I'll definitely try and address it in the session that we have. In order for you to understand this, I want you to take a look at section 2 clause 22 clause E after the session is over, because that section is a bit it's written in a complicated manner, and therefore it will be important for you to take a good look at it. Before we close, and therefore we'll do this 22 clause E in the beginning of the next session, so that we have some understanding of it. But before that, I want to close down one thing. I think when we're discussing buyback of shares, I said under the old regime, we are determined by 115 QA slash 46A slash 10 clause 34A. 115 QA and 10 clause 34A, we have read 115 QA at the company level under the old regime, not the new regime, under the regime before 2024. Under the old regime, 115 QA used to tax the company at 20% as the money went out for buyback of shares. And under Section 10, Clause 34A, the shareholder was exempt from any income tax consequences. I mentioned 46A, but I want you to note that for all practical purposes, under the old regime, Section 46A was of no use, because even though Section 46A was trying to capture a potential capital gains tax at the shareholder level, because a shareholder has given up shares and has received some money in return. But because 10 clause 34A is an exemption section, and it said, if you read 10 clause 34A, it said that um, 10 clause 34A said any income arising to an assessee on account of buyback of shares. Therefore, 46A, a potential capital gains provision, also will not apply because of the impact of Section 10, Clause 34A for the old regime. Section 10, Clause 34A says clearly that Section 10, Clause 34A does not apply with respect to any buyback of shares by a company on or after the first day of October 2024. After the first day of October 2024, the new regime applies, where there will be an interplay between 2 Clause 22 Clause F and 46A, and that interplay we have already done. In the example that we just gave you, the interplay will result in a certain amount of money being considered as income from dividends for income from other sources purposes under 2 clause 22 clause F, and then the taxpayer, the shareholder, getting a capital loss because of the way section 46A works, and that capital loss he can use to for his benefit later on, because of the proviso in section 46 clause A. Um, I think that's all I wanted to say regarding this. Um, are there any other questions or comments here? Yes, Vivek has already said that because loans are not given to the shareholders, given to the company, therefore the 2 clause 22 clause E will not apply. Will Vivek will discuss this in. I'm not discuss it in detail here, so we'll discuss that in more detail when we meet next week. So I'm going to stop sharing here, and I'm going to say happy weekend for all of you. And we will, when we come back, I'll do a little bit of discussion on the loan situation and dividends, and and then we'll go on to the next topic. But I think this session brings out all the complexities of and all the really interesting conceptual and technical challenges with tax law, which I think will hold us in good stead going forward. Thank you very much, everyone, and have a great weekend. And I will see you next time. Bye.